Today, we're diving into one of the most intriguing, maybe even mysterious parts of the financial world: dark pools. Yeah, they sound pretty shadowy, and for good reason. These are private, hidden markets where billions and billions of dollars are traded completely out of the public eye. So let me just start with a question. Imagine you're trying to make a smart investment. You're looking at the data, you're tracking the trends, but what if you were only seeing half the story? What if a huge chunk of all trading was completely invisible to you? Well, that's not a hypothetical. It's the reality. By early 2022, an incredible 47% of all U.S. stock trades were happening off the public exchanges. Almost half the market is operating in the shadows. And this is all happening in places called dark pools. So what exactly are they? Well, the official definition is a private venue for trading financial instruments. And that word, private, is everything. Unlike the New York Stock Exchange or NASDAQ, these trades are not broadcast for everyone to see. They're kept, well, in the dark. Okay, I know this all sounds a little shady, but there are actually some really logical reasons why dark pools exist and why they've gotten so popular. It isn't just about being secretive for the sake of it. The biggest users are the massive institutions, hedge funds, giant investment banks. Let's say one of them needs to sell 1 million shares of a stock. If they did that on a public exchange, that huge sell order would probably tank the price before they could even finish the trade. But in a dark pool, they can do it privately, without showing their cards and without sending shockwaves through the market. And on top of all that, they often save a ton on transaction fees. And this really gets to the core of it, right? The privacy is meant to create stability. When these huge trades are hidden, it's just plain harder to move the market. It's a tool that's built specifically to minimize impact. And make no mistake, this isn't some small niche trend. Dark pools were growing quietly for years, and then we hit this tipping point. By February 2022, public exchanges were handling just barely over half of the total trading volume. And that shift created a brand new critical challenge for every investor out there. How in the world do you get a clear picture of the market when so much of it is hidden on purpose? So this leads to the big question for everybody else, right? What does this hidden half of the market mean for the rest of us? For individual traders, for fintech developers, for anyone trying to build a solid investment strategy. I mean, look at this split. It's almost 50-50. So when you look at this standard market data that's out there, you're only seeing that 53% slice. You're effectively blind to the other 47%. A massive piece of the puzzle is just gone. Here's an analogy. Trying to invest using only public data, it's like trying to navigate a huge city, but your map is missing half the streets. Sure, you can see the big avenues, but you have no clue about all the side streets and alleys where really important stuff is happening. You're probably going to make a wrong turn. It's a huge risk. As one analysis puts it, and I love the understatement here, making investment decisions with only half the data is not generally a great idea. Yeah, you think? It's like trying to fly a plane with only one wing and just kind of hoping for the best. So what do you get when you have the full picture? Well, with dark pool data, you can finally see those giant institutional trades. You can start to anticipate big price swings. You get to understand what the biggest players are actually doing. In short, it helps level the playing field. Which brings us to the main problem. If this data is so critical, why doesn't everyone have it? Well, it turns out that getting a clear view comes at a really high price, both in terms of money and just sheer effort. So here's the tricky part. The trades from dark pools, they do show up in the public data feeds, eventually. But, and this is a big but, the little field in the data that says where the trade happened, it's just left blank. It's like a ghost trade. You can see its size and its price, but you have no idea where it came from. So finding these ghost trades takes some serious engineering work. First, you have to get access to the raw data feeds. Then you have to build a system to constantly scan for those blank fields, filter them out, and then you have to maintain this whole complex thing. For most people, that's just a hugely expensive, time-consuming distraction. So traditionally, that left you with two pretty bad options. You could try to build it all yourself, the DIY approach, which costs a fortune in time and money. Or you could go to one of the big old-school legacy data vendors, and they often charge sky-high prices, bundle the data with a bunch of stuff you don't need, and drag you through these super long, tedious sales cycles.
But the story doesn't end there. As this problem got bigger, new solutions started popping up to finally shine a light into these dark pools. And they're making this critical data way more accessible than it's ever been. And the difference between the old way and the new way is, well, it's stark. On one hand, you have the legacy vendors with their high costs and slow access. And on the other, you have these specialized vendors offering affordable prices, instant access through modern tools like APIs, and developer tools that are actually focused on what you need. The big takeaway here is that the game is really changing. Modern data providers are making this stuff available to more people. So whether you're a quant, a fintech developer, or just a really serious trader, you can now get clean dark pool data sent right to you, ready to use in minutes, not months. At the end of the day, in a market where almost half of everything that happens is hidden, seeing into the dark isn't just an advantage anymore. It's a basic requirement. This data has become a truly critical piece of any smart investment strategy. So we'll leave you with this to think about. As this hidden trading keeps growing, what does that really mean for the whole idea of a public market? Is providing access to this data enough to level the playing field, or does the very existence of these private venues challenge the idea of fairness itself? It's a huge question, and one that everyone in the market has to think about now. Thanks for tuning in to this explainer.